Most people think building wealth is complicated. They imagine risky trades, hours of research, and a little bit of luck. But for thousands of early retirees in the FIRE community, the path to wealth was surprisingly simple. They didn't gamble on meme stocks, crypto coins, or the next big IPO. They followed a minimalist investing approach called the three-fund portfolio. It's not exciting, it's not trendy, but it works. And that's all that matters. The three-fund portfolio uses just 3 low-cost index funds to give you full exposure to the global market without ever needing to pick a single stock. The concept was popularized by the Bogleheads, followers of John Bogle, the founder of Vanguard and the father of index investing. And it's designed for people who want to build wealth passively, with less stress and fewer fees. Here's how it works. The first fund is a total U.S. stock market index fund like VTI or FSCAX. This one fund gives you ownership in over 4,000 companies in the U.S., from massive giants like Apple and Amazon to small-cap companies you've never heard of. Instead of trying to guess which U.S. stock will win, you just own all of them. Next is a total international stock market fund like VXUS or FTIX. This gives you exposure to thousands of companies outside the U.S., in Europe, Asia, Latin America, and emerging markets. Now, your investments aren't just tied to the U.S. economy. They're connected to global growth. The third piece is a total bond market fund like BND or FXNAX. Bonds provide stability. When the stock market dips, bonds usually hold steady or even rise. This balance between stocks and bonds protects your portfolio in downturns. With just these 3 funds, you can build a globally diversified, low-risk, long-term investment portfolio. Let's talk allocation. A common split is 50% U.S. stocks, 30% international, and 20% bonds. But some investors prefer 60-30-10 or even 80-20ths with no international exposure. It depends on your age, goals, and risk tolerance. The beauty is, you're in control and there's no perfect mix. What matters most is staying invested and staying consistent. Here's why the 3-fund portfolio is so powerful. First, diversification. Instead of putting your money in a few companies, you're investing in over 10,000 companies worldwide. That means if one company fails, or even one country's market crashes, your wealth is protected by the rest. Second, low fees. Index funds usually charge 0.03% to 0.10% in fees. Compare that to 1% or more from a financial advisor or actively managed mutual fund. And that 1% can eat away tens of thousands of dollars over time. Third, time-tested performance. Study after study shows that passive index investing outperforms most active managers over the long term. And fourth, it's simple. No watching charts, no checking earnings reports, no emotional trading. Just auto-invest every month and let time do the heavy lifting. Still not convinced? Let's look at an example. If you invest $500 per month into the 3-fund portfolio for 30 years, assuming an average annual return of 8%, you'll have over $680,000. If you can bump that to $800 per month, you'll pass $1 million. Even at $300 per month, you'd still grow to over $400,000 from just staying consistent. That's not luck. That's compound interest, the most powerful force in personal finance. And the earlier you start, the more time your money has to grow. People in the FIRE community, short for Financial Independence Retiree Early, have used this exact strategy to leave their jobs in their 30s and 40s. They didn't inherit wealth or get lucky. They lived below their means, invested consistently, and stayed the course. Here's a real example. Brandon from Mad Fientist retired at age 34 using the 3-fund portfolio. He invested aggressively, avoided lifestyle creep, and let index funds do the work. Another case, Christy Shen, author of Quit Like a Millionaire, built her 7-figure portfolio in under 10 years using index funds. No stock picking, no speculation. There are thousands of others like them, many who started with nothing. Now, some people ask, what about dividends? Great question. Many of the companies in the U.S. and international stock funds pay dividends, and they get reinvested automatically, compounding your returns. Others ask, what if I'm starting late? Even if you're in your 40s or 50s, it's not too late. You can still use this strategy to build a strong retirement cushion. If you're older, you might want a higher percentage in bonds to reduce risk. Maybe 60% bonds, 40% stocks. Remember, it's not about timing the market. It's about time in the market. You can start with platforms like Vanguard, Fidelity, Schwab, or M1 Finance. Most of them let you open a Roth IRA, traditional IRA, or taxable brokerage account. And you can automate your contributions so you never have to think about it again. Want to simplify it even more? Use target date index funds, which automatically adjust your stock-bond mix as you get closer to retirement. They're often built from the same 3 core funds, just bundled together. So here's the big idea. If you want to build real, lasting wealth, if you want to retire early, if you want peace of mind and not panic, you don't need the next hot stock. You don't need a finance degree. You need the 3-fund portfolio and time. And if you want help mapping out your long-term investing plan, I've created a free toolkit and a passive income planner. It's linked in the description below. Inside, you'll find templates, calculators, and tools to help you automate your wealth-building strategy. Just like the pros. This isn't a get-rich-quick strategy, but it's a get-rich-for-sure plan, if you stay consistent. Thousands have used it to retire early, and now it's your turn. Click the link in the description to get started. And subscribe to Nesta Grow I for more proven strategies to build long-term passive income. Thanks for watching, and remember, buy, hold, relax, retire.